Welcome back. The gold market is melting hot right now. Banks stocking up on the commodity as it continues to skyrocket in price.
So is now the golden time to invest in the precious metal? Money expert Joel Gibson is here to tell us all about it. Joel, what's behind this boom?
Well, look, clearly it's the tariff war and the problems on the US stock market are driving up the price of gold, but it was already doing pretty well for a couple of years before that, so it's been a steady rise. This is just in the past year. It's up around almost 50% over the past year.
Wow.
It's now at 5,200 Australian dollars roughly per ounce. Of course, no one knows what an ounce is, so look, just to give you an idea, this phone I've got right here weighs a little over 200 grams. This would be worth around $44,000
Wow.
if it was solid gold. So that's how much gold is worth right now. A 1 kilo block, 160,000 Australian
So
dollars.
you'd be looking at it, go, all right, well, and there are reasons for it. And whenever there's world instability, gold goes up.
Yeah, safe.
Some problems with tariffs, with currencies and all that.
Yeah.
How can someone get involved in it without having to go through $44,000 for something of that size?
Well, look, you can buy gold, you can buy bullion, you can even buy coins if you have a smaller budget. But the fact is there's all sorts of different ways to benefit from the gold rush.
Okay, so what if we were to invest as an Aussie in the smallest amount we could? It's just a coin.
It's a coin. It's a coin. In fact, some coins are actually legal tender by law in the US and Australia and other countries. So you could actually use that to buy some milk at your local corner store. One other thing that's really interesting, there's this thing called the gold to Dow ratio. Only 3 times in the last century has it flipped in favour of gold versus the Dow Jones. The last 3 times, the Great Depression, the 1970s oil crisis and the tech wreck, it's just done it again. So keep an eye on that one.
My mum and dad had a gold bullion in the.
My mom and dad had a gold bullion? Mate. Alright, we're going to get back to that hard-hitting analysis in a minute. First, I'm flipping these charts vertical so you can visually see the wild swings in relative values between stonks and a gold bullion tucked away somewhere safe amongst mom and dad. The line running through it in the middle, or the median in terms of swings ups and downs, and now that we've gone vertical, it's left or right here. Over the last 100 years of United States financial history, just under about half of the last century, the Dow gold ratio has hovered above 10 ounces of gold bullion to buy 1 share of the Dow, peaking in the 2000 tech bubble, where delusionary stock prices of then Dow rotating company composite index cost just over 40 ounces of gold per share. Whereas for a bit over half of the last 100 years of time, it's cost less than 10 ounces of gold to buy 1 share of the Dow. And when it does break hard right on this chart, the past 2 times, it's bottomed between 2 ounces to as little as 1 ounce of gold, briefly, to afford the Dow Jones Industrial Average. Today, we close this ratio at 12.75 ounces of spot gold to afford a share of the still well overpriced U.S. mega corporate Dow. The silver side of this long-term swing trade is, of course, more volatile and manic depresso. Right now, silver is again depression, spat upon by ignorant normies. We can go back to even the 1890 Sherman Silver Purchase Act. There's been times in U.S. financial history when as little as 20 ounces of silver bought a share of the Dow. Well, the spike low in 1980 is very obvious on this chart. You can see it spiking far right to the extreme. And cut closer in time to about 2 dozen years ago in May 2001. Then it cost over 2,500 ounces of silver to buy 1 share of the overvalued Dow stock bubble at the time. Everyone, virtually any yuppie you talked to, thought they were a day trader. It was clownish. Once it crashed, I got my diploma. Welcome to the real world, kid. Good luck. Considering gold versus silver over the large, somewhat recent swaths of time, instead of a swing factor of more than 40 for gold, silver has seen swings of 125 multiples in just over 2 decades within most onlookers' lives watching this very video. The one omnipresent in markets is that they swing from fair value to overvaluation to extreme undervaluation. And in terms of bullion versus the present-day U.S. stock market, they are both still undervalued. Silver is still extremely cheap, currently costing nearly 1,300 ounces of spot silver for the overvalued Dow. No, without silver, your AI delusions cannot come about. And no, I'm not dumping 2.5 mint cases of silver bullion sovereign coins for your overvalued Dow bubble. Maybe when you again humbly cost a few tubes, we can talk. Back to this hard-hitting Aussie gold news break.
So keep an eye on that one.
My mum and dad had a gold bullion in their wardrobe. It was hidden behind like
Wow.
all sorts of stuff back in the 80s when they thought the Soviets were going to kill us.
Really heavy?
Full conspiracy theorists. Yeah, it was
What did
really
they do
heavy.
with it?
I don't know.
You could try and find it.
Actually,
Maybe
I
it's
should
still
get in
there.
touch with Mum.
Yes, Jenny, have you still got it?
You've just told everybody where their money
Excuse to ring her now. Thanks, Charlie.
Nervous laughter melting away, just like your currency and housing bubble is to gold, and later on comes silver. Let's check in on the 3 largest Aussie metros and their overpriced, debt-laden housing bubbles, shall we? Here's Sydney. Nah, mate, can't afford to live there. Not cheap as chips at all. Since the 2008 global financial crisis, debt-fueled housing prices on a nominal basis in Sydney have threefolded. In gold and silver bullion terms, the story is a bit different, though. Look for Sydney houses to get one-thirded by the end of this building gold bullion mania phase as the bubble built gets melted down by gold accounting. Silver, the story is slower until it isn't. It's possible that a house in Sydney in real terms loses something like negative 90% to silver bullion in a coming mania phase spike. Keep laughing, jokers. You're the dumb money now, so sit back in your overpriced house tonight and transfer your real wealth to bullion owners in the years that are coming ahead. You're not getting out of here either, Melbourne. Doubled your nominal housing prices from post-2008 global financial residential debt explosion. How about we throw some bullion on this, huh? How about 75 ounces of gold for your shack or 2,000 ounces of silver for your shanty by the year 2033? Is that a good conspiracy? Brisbane, you're not getting away either. Let's have a hard money look in the mirror as well. Nearly 2.5 nominally priced higher since the 2008 GFC. Oh yeah, time to bust through with some relative Brisbane house versus bullion value charts. Looks like your housing price could be halved and or quartered in terms of gold bullion from now to perhaps the 2030s. And the silver side, you get a repeat of what happened in 1980, where nearly all commodities multi-folded regardless of what Hunt Brothers scapegoat that you think actually occurred. You could see a relative silver valuation loss in your house by well over negative 90% as well. I know, it sounds nuts. That's why I'm showing you this with damning data painted on these charts. You can't make it up. You see, from time to time, a few decades to a few decades, commodities, and especially precious metals, move from severe undervaluation to overvaluation relative to all goods and services within economies. Now here, U.S. stateside, gold just recently broke out and is consolidating relative gains before running again. Silver is still in slumber mode, but just like in Australia now, your nominal silver price has broken beyond your 1980 and 2011 nominal price highs. The same is coming U.S. stateside. If what I'm going to show you on the other side of this break comes true, well, 1980 is going to end up seeming so very quaint and cozy in comparison. Stick around.
Hello, this is James Anderson on behalf of SD Bullion. Smash the like button if you enjoy these bullion market updates.
And be sure to visit sdbullion.com/sweepstakes to enter our free 500-ounce silver coin giveaway.
The worst day on Wall Street since the crash of 1987.
We're now down 43%.
This could be the most serious recession in decades.
Protect your retirement with gold and silver IRAs. Learn more at sdbullion.com/IRA.
The silver and gold markets sold off this week with Chinese precious metals trading closed for local holidays. The spot silver price finished just over $32 an ounce bid, and the spot gold price finished close to $3,240 an ounce bid on the week. The spot gold silver ratio ended the week still triple digits, historically high at 101. The World Gold Council just reported the highest gold demand for Q1 to begin a year since all the way back to Q1 2016, back when gold was about a third of its current nominal price of today. And even though gold jewelry sales are down, unsecured gold ETF demand, especially in Asia, and gold bullion buying, especially in countries like India, China, Japan, Korea, Vietnam, you name it, Gold demand is strong, with the ongoing structural trade changes afoot. That, what you're looking at, is apparently how much large denomination note Chinese fiat yuan cash it now takes to afford just 1 kilo of gold bullion. Of course, that pile's going to grow bigger in time. Here's a fun little data fact on the US ubiquitous iPhone. In its launch in early 2008, back when QE1 was just getting underway, the spot silver price was 11 an ounce. The retail iPhone price has basically 3-multipled in its fiat US dollar price from $500 to $1,500 now, but in real value terms, it costs only 1/3 in silver bullion today versus what it did back then. Yeah, so not just overvalued bubble stocks or debt-laden mortgages, but near every good and service you can think of is going to melt in real value terms versus bullion to come. Longtime real estate and U.S. bank analyst Christopher Whalen has been out in media promoting an update to his book entitled Inflated. Now, I'm going to receive his updated book in the mail soon, but I want to take you through some of his many points he's made and have stuck with me for many days now from watching here on YouTube. Have a look.
Back to some old-fashioned concepts here, because for a long time, the dollar was just assumed to be strong, and we had to live with it. So no matter how those terms of trade disadvantaged American companies and forced them to move their operations offshore to venues with cheaper currencies, now it's going the other way. I also think the fiscal situation certainly, justifies a weaker dollar. Congress has to start feeling the costs of their refusal to do their jobs. That's the bottom line. And, the notion that Trump and the rest of these guys on Capitol Hill are looking to cut taxes more, we should just leave things as they are and freeze spending. But they were unwilling to do that. I talk about this in the book. Americans, going back to our inception, have had a really hard time paying their bills. They love borrowing money, but they don't like taxes. And I'm talking about back to the 1700s. So, this is consistent. And I think it continues, by the way. I don't see any way out of this without crashing the ship. And I don't think the ship is going to crash necessarily.
You don't think the ship is going to crash? How do they save it from crashing? Who steps in?
They hyperinflate. The Fed basically monetizes the federal debt until they can't anymore.
Pause. Now, I know that sounds glib and hopefully far out in the future if somehow it never comes to pass, but think about it. If and when the time is right to wipe the deck clean, you can wipe the USA's current record debt pile clean by 4 consecutive months of 50% inflation per month. So let's do the math. 36 trillion becomes 18 trillion, then 9 trillion, then 4.5 trillion. So in real terms, you can knock out about 90% of the blooming debt by a whoopsie hyperinflation lasting about 1/3 of a hellish year, hopefully, again, never comes to pass. The best expression of what this is like to live under is simply going to the same restaurant each morning, ordering the same thing each day, but having to ask what the new price is for your meal. I know arrogant listeners out there like to not think about the 200 trillion in unfunded liabilities coming due in the decades ahead. Of course, that's not going to cause us to increasingly monetize or balloon our ballooning debt piles. That only happens elsewhere, right? Hyperinflation only happens to them. Sure. How about forcing the banking system to again have to hold secular bear market financial repression U.S. bonds on their books akin to post-World War II USA? Well, Chris suggests that's coming too.
It's almost like Argentina. If you look at Milei in Argentina and the progress he's made, turning that country around, we face the same problems in the U.S. Our society just refuses to accept limitations on their actions, on their consumption. And the net is that we end up with a federal government that is, pretty deep underwater.
Is the Fed already preparing that bailout?
Oh, yeah, very much so. One of the things we talk about in the book is some recent research that was done, particularly a paper by a fellow named Josh Younger and Lev Manand for Columbia University Law School, where they talk about the legal basis of the Treasury market. Where did this come from? Did it just erupt out of the ground? Did people just decide, hey, let's go buy some Treasury bills today? No, they had to be sold. That market was constructed very carefully by the folks at the Fed in the 1950s. They created what we called primary dealers. Now, the only trouble is, in 2008, we annihilated half of the primary dealers. They ended up getting bought by banks. So today, the Treasury market is basically a carry trade with a lot of hedge funds using 100 to 1 leverage. That's the market for Treasury debt. And that's the big vulnerability that the Fed worries about more than employment, more than inflation.
Bingo.
The single biggest mandate is keeping the Treasury bond market open every day.
That is such an important point you made right there, Chris. The vulnerability of it. Do you think that's the most fragile link in the entire system? If I had to ask you, where does it break?
Yeah. Well, it doesn't break so much, but it forces the cost of funding up for the government. It forces a change in the composition of people who are willing to hold Treasury debt. I think you'll see banks forced to buy more of it. This will be additional financial repression on the banks, right? And, how does this end? It ends with the banks looking like they did at the end of World War II. If you looked at most of the big banks in the U.S., half of their book was government bonds. Because everything had been about government during the Depression, during the war. That whole 25, 30-year period was about big corporations, big banks, and the U.S. government as the financial source to make the whole thing work. And that continues on into the late 70s. That was when you saw non-bank finance come back.
In another interview, Chris gave a shout out to the radically high spot gold-silver ratio at the moment, suggesting that it will come roaring back lower.
The silverites want to get back. What's the ratio between silver and gold now? Do you know?
Above ground?
Yeah. No, I mean the price ratio.
Oh, the price ratio. I think it's getting close to 100.
Yeah, okay. Let's say it's roaring back. There was a time that we talk about in Inflated when the silverites in the West forced the Treasury to buy it with paper. And so as soon as people got paper, they get rid of the paper and they bought gold.
Right. Yeah, I know. Glib. They bought gold because silver was demonetized, and their burdensome outstanding debts at the time were denominated in gold, not silver. Baron Rothschild in the French Monetary Convention of 1869 literally said the following, quote, "The suppression of silver would amount to a verifiable destruction of values without any compensation." Of course, then he and his City of London bankster buddies colluded with U.S. banksters in the Northeast to end up demonetizing silver about a decade later, and all hell of a sheeple shearing and bankster consolidation of the Midwest and West ensued. California was mostly spared thanks to their ongoing gold rush at the time. Today I was playing around with Google's AI, and it played dumb until I shook a source out of it for the quote. That's another book I purchased today. Of course, more on the silver demonetization history another time. That's a long rabbit hole. We're not doing it all tonight. We are likely hell-bent on a path as a nation towards the possibility of blowing this version of the fiat greenback away yet again. Silver and gold will be there to account for that destruction by rapidly increasing values to come. This is just a historical rhyme in time repeating yet again. And no, this is not the 1970s. The underlying situation here and abroad is way worse today than then, and that's the same case for most places around the world. Inflation on a massive scale is the likeliest way out until a new monetary system and potential new U.S. currency unit might be required. Okay, I'm not going to leave you with a scary taste in your mouth tonight. We're going to end with some highlights from last week's final trading day of the month, Twitter X Silver Squeeze Flood the Zone celebration. It included an 8-hour marathon of spaces, which is basically a little place where a whole bunch of people get on Twitter and talk. And so it's just a huge conference. It was a lot of fun. A whole bunch of like-minded bullion stackers who were celebrating the day and month of adding ounces of real wealth to their lives. Here are some highlights.
You're a madman. I've come to the right place then.
That will be all for this week's SD Bullion Market Update, and as always, take great care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.